Good afternoon. We're just going to wait a couple minutes to allow people to let themselves in and adjust audio, and then we'll get started. Okay, let's go ahead and get started. Welcome to Tax Planning Best Practices. My name is Gina Marias, and I'm an advisor at Summit Financial Group. I'm joined today by Jay Gilson, who has been a CPA for over 40 years, and in 2015, we convinced him to join our team as a consultant. Jay is a wealth of information when it comes to tax, and we hope our time together today will be useful in tax planning. Due to the nature of the content today, we will not be opening the question and answer queue. When it comes to tax planning, questions are often situation specific and personal. Jay is available to clients of the firm, and if you have a specific question, please reach out to your advisor and we will get back to you. Jay, why are we talking about this in April versus at the end of the year when we see so many articles about tax planning towards the end of the year?
Well, I think the big challenge is at the end of the year, many of the decisions have already been made that will affect your tax situation. And waiting, while all the articles and all the literature is, you'll see them coming through hot and heavy starting middle to late November and through December. Well, 11 months have gone through. Maybe you would have done something a little bit different. So I always think it's good to start doing the planning. And personally, I've already run projections, surprise, surprise, for the 26, 27 years. So I kind of have a handle on what's coming. But you need to have the opportunity and the time to decide what you want to do as when it comes to tax planning. I just think it's a lot easier to be well ahead of the game, and your own CPA would much rather be doing it in the April to September timeframe rather than in December with a lot of the other clients.
Okay. So what you're telling us is that we should really look at tax planning not as an end of year decision like we typically get flooded with articles around, but something more to do throughout the year as our income and our ideas around what we want to accomplish change.
Exactly. And I think if you have kind of what you're looking at a year from now for what you've got to do, it also makes it a little bit easier making, I think, fundamental business decisions or personal decisions of, well, do I have the money really do this, or do I need to be aware of something? Or maybe what I'm going to do is just push off some decisions a little bit. I just think giving yourself time and breathing room allows for a little bit of clarity on the situation.
Okay, perfect. Well, thank you for that. Let's go ahead and jump into some of the topics that we have today. First of all, we're going to talk through Roth IRA conversions. So before we jump into Roth IRA conversions, let's walk through a quick overview of how they work. So Roth conversions take pre-tax dollars from your IRA account and they convert them over into your Roth. Now, there is no limitation to the amount of money that you can convert from your IRA to your Roth IRA each calendar year. Remember, though, when we take funds out of the IRA account, they are income taxable to us during that calendar year. So when we're doing a Roth conversion, if I convert $50,000 from my IRA into my Roth IRA, I will receive a 1099 at the beginning of the following calendar year, and I need to make sure I pay income taxes on that conversion. If I'm going to do a Roth conversion, I want to make sure that I have the funds to pay the tax in cash, money market, CD, etc. I don't want to pay the tax using the IRA dollars. So this is something that we don't want to wait to the end of the year to start thinking about because it takes time to do a Roth conversion. We have to make sure the Roth IRA account is set up. We have to ensure there's ample time to transfer the funds. We need to run some tax projections to look at your specific tax situation, determine how are we paying that tax, and then of course consulting with your advisor and your CPA, because this decision really is a fact dependent decision depending on your specific situation. And Roth conversions, doing them now versus later, can really affect taxation when we're looking at taking required minimum distributions into our 70s, in addition to Social Security income and other income. So Jay, can you tell me why it's important from a tax perspective to do this planning now? And a secondary question to that is, if we did all the planning now, would we want to do the conversion now?
Well, it just comes back to, I think, power comes from knowledge, and knowing what the effect is going to be to you on the conversion and what the taxation is going to be and what the cash requirements are going to be all play into the decision. And again, if one is contemplating a Roth conversion, start running the scenarios right now. Mm-hmm. Just because you run a projection doesn't mean it's going to happen. Something may happen, let's say down the road, it's like all of a sudden you have a windfall. You're out, you played the lotto, and all of a sudden your income goes through the roof, in which case your tax bracket may be higher than you expect. So you pull the trigger on the Roth a little bit later. Again, recognizing the timing is, I think, really, really critical. And what you don't want to do is get caught where there's not sufficient time, as Gina said, set up the account, transfer the funds, raise the funds to pay the tax. Well, that always can be done later. The other thing that plays into it, and we'll talk about a little bit later, is what's the effect to your estimated tax payments that you need for the year of the conversion. And then another kind of ancillary idea is, do you do a single year conversion? Let's say you're aiming at converting $100,000 from an IRA to Roth. Do you do it all in 1 year? Or do you trickle it out in a couple of years? Do you do it all this year, or half of it this year and the other half towards the end of next year? Or do you break it over 3 years or 4? But by kind of looking forward and taking an active role and thinking about what alternatives you have, I think is really, really critical. And what's surprising is, it used to be I could do tax projections and have a pretty good idea what was going to happen. In the last 15 years, with all the different brackets and the rates and the shifts, the different thresholds and stuff, sometimes you're really surprised by the outcome. But a lot of times what you're really trying to do is, with a conversion, is, let's say you've only just broken into the 22% bracket. Well, maybe it's good to fill up that bracket with Roth conversion to take advantage of full to 22%, because in 2 years, you're going to be facing a required minimum distribution, and your tax rate is going to be 30, 40% combined fed and state. So I think, again, it is, knowledge is power. Knowledge is where you're going to be able to make, I think, a really good decision and talk about it. Again, you do not want to take the money out of the Roth, take it, kind of split the money and say, well, I'm going to take $100,000 and I got a $30,000 tax bill, so I'm going to take the $30,000 out of what I converted. Well, you got to be careful. Number one, you don't want to do that. You're losing some of the earning power. But the second thing is, you may be now facing a penalty for an early withdrawal. So you've got to really, I think, understand all the permutations.
Okay.
It's a good puzzle. It's a nice problem to have.
Hence why consulting with your advisor and your CPA are important when making decisions like this. So another tax planning tool that we just want to make sure that we're looking at when we're starting planning this early in the year, as Jay mentioned, is just looking at where we're at in the current tax bracket for the year. Oftentimes, like Jay said, when we begin taking those required minimum distributions into our 70s, we are typically in a higher tax bracket than we were when we retired. So being able to look at the taxation and where the tax brackets land each calendar year really is helpful when you're doing this type of planning, and then consulting with your advisor and your CPA, because the conversion is an irrevocable decision. Once you do the conversion, you cannot go back on it. Correct, Jay?
Yes, absolutely.
Okay, perfect. Let's go ahead and talk through stock and bond tax loss harvesting. So first of all, no one invests to lose money, but it does happen in our after-tax investment accounts. So this planning does not apply to retirement accounts. And what this type of planning looks like is that throughout the calendar year, you should be reviewing your after-tax investment accounts to see if you have any losses that you can capitalize on. Now, tax loss harvesting allows you to sell a fund at a loss, purchase a similar fund for 30 days, and if you desire, go back into the original fund after 30 days. If you buy back your original investment prior to the 30-day window, the capital loss cannot be used, as that is considered a wash sale according to the IRS. Now, a wash sale is selling a fund at a loss and buying it back within 30 calendar days. So one thing to remember is that we want to continue exposure to the market. You don't want to sit in cash for 30 days. So you can choose a similar fund to purchase for the interim. And then once that 30-day window is opened, you can choose to buy back your original fund. Now, once you have that loss, the capital loss can be used to offset capital gains. If you have a loss to offset a capital gain, you're not paying any taxation on that capital gain. If losses exceed the capital gains in a given calendar year, you can deduct up to $3,000 against your income for that calendar year. And any excess loss that is not used in that calendar year will carry forward on your tax return until it is used in full by either capital gains or deducting $3,000 against your income each calendar year going forward. So Jay, from a tax planning perspective, can you walk through the tax side of this?
Yeah, it's interesting because even some of the advisors at Summit will ask me this question. Well, I'm going to sell my house at a capital gain. Can I use a capital loss against that? Well, I've got a piece of art that I'm selling at a capital gain. Can I use my capital loss against that? I've got a lot of capital gain dividends that are coming through. Can I use a capital loss to offset that? And the answer is yes, yes, and yes. If the transaction is a capital transaction, and that's defined in the Internal Revenue Code, there is a netting process. And if you really want to see how it works, if you pull out your tax return and look at Schedule D, upper part of Schedule D is a section that's short-term capital gains and losses, and the lower section is long-term. And what you have to do is net all your short-term gains and losses to come up with an overall short-term gain or a loss, and net all of the long-term gains and losses to come up with an overall long-term gain or loss. And then what you do is you take a look at it. If it's all gains, then the long-term gains will be taxed at a preferential tax rate. The short-term is taxed at your normal tax. If you've got capital losses in excess of the short-term gains, then there won't be any taxation at all. And as Gina said, the capital loss carry forward goes forward as long as either you're alive or you use it up by offsetting other capital gains or losses, or the 3,000. One thing I want to jump back to just really quick is everybody says, well, wash sale, then it disappears. It really doesn't. What happens in a wash sale is the loss is added back to your basis. So it's as though the sale never happened. So you don't lose it. It's just not usable in that year. But, you know, if you are selling something at a gain, and frankly, you know, what, Gina, correct me, what in the last 6 weeks, there's been some volatility in the market.
Yeah.
And I think there were a lot of opportunities. I think it's kind of come back. They may have disappeared at this time.
Yeah.
But, glomming onto those losses, even if you look at it, in some cases, you can look at the losses could be a very large number. Don't freak out because invariably we believe that the market will come back, or we certainly hope it will, and you'll be able to offset it down the road.
Thanks, Jay. That was helpful from a tax planning perspective. Anything else on stock and bond tax loss harvesting?
Not really. It's nice when it happens.
Yeah, it's helpful for taxes for sure.
Especially when you look at your portfolio afterwards and it's still going up. So
yes, absolutely. Okay, let's go ahead and talk through retirement distribution planning. Now, there's a lot on this slide here, so let's walk through what we're looking at first. As we approach our 70s, we need to be clear on when we are forced to take a distribution from our retirement accounts. So if you were born between 1951 and 1959, your required minimum distributions are going to start at age 73. And if you were born 1960 or later, your required minimum distributions will start at age 75. Now, it's important to note when those required minimum distributions start because you want to plan accordingly. You want to avoid having to take 2 required minimum distributions in the same calendar year. So to do that, most people choose to take their first required minimum distribution by December 31st of the year that they're eligible rather than delaying it any longer. Something to be aware of. In addition to that, on this slide here, you're going to see that we have tax rates. We want to be aware of our income tax bracket and how taking your required minimum distribution are going to change that bracket. Required minimum distributions are income taxable to you. So if you have a required minimum distribution of $35,000, that's $35,000 of additional income that you will need to pay taxes on in that calendar year. In addition to that, if you are on Medicare, and most people are after the age of 65, you pay a premium for Medicare Part B and Medicare Part D. And according to Medicare, there is something called IRMAA. There's an acronym on the screen there. It's Jay, correct me. I'm going to say
no, I'm not. It's just a mouthful.
So what IRMAA does is it's the adjusted brackets for your Medicare costs, and it's based on your adjusted gross income from 2 years prior. So for calendar year 2026, if you are on Medicare, your Medicare Part B premium is going to be derived based on your 2024 calendar year tax return. And your 2027 Medicare Part B is going to be derived based on the 2025 calendar year tax return. Now, as you can see here on this chart, if we look at married filing jointly, and if your adjusted gross income is $218,000 or less, your Medicare Part D is going to be $202 per person. But if you actually go above $218,000 of income for married filing jointly, your Medicare Part B premium in the next bracket is going to be $284 per person. Now, this type of planning is important to look at, especially when we're taking additional distributions or required minimum distributions from retirement accounts, because this can go ahead and increase that income tax bracket and increase the cost to Medicare to you, which is then readjusted each calendar year. Now, IRMAA stands for Income-Related Monthly Adjustments to Medicare. So that is what that stands for. There is detailed information on the Social Security and Medicare pages on the web, so please don't hesitate to look there for detailed information on it. And then Jay, can you walk us through, I know you have a personal situation with this for required minimum distributions and IRMAA. Can you walk us through that personal scenario that you're dealing with so clients can get a better understanding of how this can affect them tax-wise?
Well, it's interesting. It's kind of talking about tax planning as a full circle. I have a very, very good friend who passed away suddenly, and we think it was of a massive heart attack, literally a year ago on Easter. And his wife, we started talking about what she needed for cash flow. And this is a friend, and just doing tax planning like I always do for everybody. We started talking about it. She goes, well, I'm going to need some cash. And she has to take money out of the IRA that she inherited from her husband. Mm-hmm. And so we spent some time talking about what it was. And I said, well, give me what you think you're going to need. And she came up with a number. She said, so I'm going to take that out. I'm going, well, let's talk about that. And because the amount that was required to be taken out was about 25% of that number. And I said, if we only take out what's required, because my friend was in pay status, he had met his RMD, the date that he had to take the distribution. And since he hadn't taken distribution before he died, we had to take one out of the IRA. If we wait and just take the 25%, her IRMA doesn't get adjusted until, because we're in 2025, until basically 2027. If we adjusted the whole thing, the 2027 IRMA would have been higher. Mm-hmm. So if we wait and take only what she's required, but what she then needs in January, her IRMA adjustment is in 2028. So what we've done is we've gained the use of the funds of the increase in the premium for those almost 36 months, which just makes a whole lot of sense. Just as an aside, on the just to be clear, the Part B premium of $202.90, everybody on Medicare has that.
Yeah.
It starts increasing as your income gets up higher. But I just think it's really kind of interesting if you're in a position of having IRMA adjustments, it kind of hurts, but then by the same token, it's nice to have that kind of income. But it's a bittersweet pill.
Yeah, but there is some tax planning that can be done around that to maybe every other year offset some of those IRMA adjustments based on distributions to retirement accounts. So that type of tax planning takes forward thinking and then working with your advisor and your CPA to be aware of what your adjusted gross income is going to look like for the calendar year. Jay, can you kind of walk us through qualified charitable distributions?
Yeah, okay. So with all planning, I think you've got to be careful and understand what's the motivation behind it. If you are charitably inclined and you've got sufficient money and you are falling into an RMD position, then what you can do is what's called the QCD, a qualified charitable distribution. And that is from your IRA trustee directly to the charity of an amount not to exceed $100,000. You've got to be over 70.5 for this to work. But that $100,000 is counted against your RMD or whatever dollar amount it is. Maybe your RMD was only $30,000. You could do a whole 100% of that $30,000 directly to charity. You don't get a charitable deduction. You don't pay tax on it. You meet the emotional need of what you've committed to doing, and it doesn't hit your IRMA. So it's really kind of a cool way to knock off a number of things that you must do or you need to do with as little effect as possible. But again, I think you are going to be out. Your cash flow is not going to be neutral. If you give away $30,000, it's going to keep you in a better position, but you're still out the $30,000 that goes to the charity. But if you're going to make a charitable deduction anyway, or a donation anyway, it's 6 to 1, half dozen the other, and there's no tax hit.
Okay, thanks for explaining that. It sounds like we don't ever want to make a totally tax motivated decision. And my favorite comment from Jay that he always tells us and has told us since he started with us in 2015 is don't let the tax tail wag the dog. I think that's the funniest thing. Let's go ahead and walk through maximizing retirement plan contributions. So this is important to talk about now. As Jay said, we're getting, we're 4 or 5 months into the calendar year, and we want to make sure we're doing the right thing with those retirement plan contributions. We're talking about this now too, because these contributions have to be done before December 31st. So first of all, starting in 2026, employees over the age of 50 who earn more than $150,000 based on their prior year W-2 wages are required to make their catch-up contributions to their employer retirement plans as Roth contributions, meaning those dollars are taxable rather than pre-tax. So if you're over age 50, you made over 150,000 last year on your W-2, your catch-up contributions need to go into the Roth portion of that retirement account rather than the pre-tax portion of that retirement account. Additionally, beginning in 2025, individuals ages 60 to 63 can have access to higher super, what we would call super catch-up contribution, allowing them to save more during their peak earning years. So together, these changes make proactive tax planning and Roth strategy coordination more important than ever. Now, in addition to that, if you're under the income limitations to contribute to a Roth IRA, you don't want to wait until the last minute to contribute due to timing. So start planning for that contribution now and ensuring you have ample time to get it completed. Those need to be completed before April 15th. And the same applies to the IRA contribution. That is also due by April 15th, but it is best not to wait to the last minute given the timing that's involved in that. Jay, is there anything that you think that we should add to that part that would be beneficial for tax planning?
It's more of a rule now. It used to be if you put your tax return or an IRA contribution in the mailbox when it was given to the post office, it was deemed delivery, and you could do it in the evening at 11 o'clock at night, and it was deemed a contribution on 4/15. Now what the IRS is saying is it needs to be postmarked on April 15th, no later than. If it's April 16th at 12:01, you're late, and the deduction is not valid. And let me tell you, that really creates a mess in trying to unwind that if you have to. So there's a couple things in the IRA. One of the things is I've seen where people have funded the IRA or the Roth in January of, let's say, 26, and they get to the end of the year and all of a sudden they've made too much money. That's equally, it gets to be a problem. So it's kind of a double-edged sword. The sooner you get the money into the IRA account, the sooner it's going to earn tax deferred. Yeah. But you can really create kind of a mess. So I think that this is kind of where the planning comes in and says, okay, in December, you start looking at it and say, yeah, I'm not going to run afoul of having too much income, and I can do an IRA. And then you make the contribution. But really, I think all of the advisors around the world would love it if that decision was put in works by March 31st, just so there isn't a hassle. I mean, I literally got 2 emails at noon on April 15th saying, hey, can I still make an IRA contribution? I go, it's got to be in today. We got to transfer the funds. And they're going, well, it's not going to get journaled tomorrow. And so they literally brought in a check. It was delivered to us. We receipted it. That was delivered to us. It's in our hands now, in our control, and it's a legal tender, so it was then legal. But let me tell you, it gets to be kind of anxiety provoking, especially if you're running really late and traffic is bad and you can't get to the office fast enough. So
yes, absolutely. And April 15th is always a busy day, or it's always a busy week for our office for sure. So
yep.
Thank you for that. Let's go ahead and walk through maximizing HSA contributions. So these are health savings accounts. And if you are enrolled in a high deductible medical plan, you do have the ability to have an HSA account, which is a great way to do some pre-tax planning and get pre-tax dollars into the HSA account. So that way we're not paying tax on medical costs. So you don't have to use the dollars during the calendar year. They can roll over each calendar year for future medical costs. But again, you can only make contributions to these plans if you're in a high deductible medical plan. Now, Jay and I have included the 2026 contribution limits on this slide for reference, something to be aware of. And we always recommend as advisors that if you have an HSA, if you can afford to fully fund it, let's go ahead and fully fund it, because that HSA can pay for all future medical costs, including, if you still have it in retirement, Medicare, and all of the copays associated with those medical costs in retirement. Jay, do you have any tax planning tools for HSA accounts that would be helpful for clients to be aware of?
Um, it's really pretty simple and straightforward. If it's available, do it.
Yeah.
The other thing is recognize as you approach retirement and get to the point where you are eligible for Medicare, for original Medicare. The date that you apply on original Medicare, there's a 6-month look back and you are deemed not to be in a high deductible plan for those 6 months. So it's really easy to end up overfunding it. It doesn't mean that you lose your HSA. It just means you don't get to make contributions. And personally, I tried to time it. I missed. I ended up having to take money out of the HSA because I put too much in, and I forgot about the 6-month look back. So I had 4.5 months of contributions I had to take back out. So, but it's easy to have happen, and it's easy to run afoul of. So anyway,
yeah,
but
and it doesn't
it's
affect
worth doing. It's really worth doing.
It doesn't affect the account. Jay just had to take the contributions back out, and he still has the HSA available. That's funny, Jay. Okay, let's go ahead and walk through state and local tax deductions, otherwise known as SALT. So many of my clients, after doing their tax returns this year, came to me and said, we got more of a refund because of SALT. What is SALT? So, Jay, can you walk us through SALT? What's changed with the new tax law? How it affected clients for the 2025 return, and anything you think would be helpful for our clients to know?
So up to the beginning of 2025, or for about the last 4 or 5 years, being in California, it's really painful because many of us pay far more than what we were able to deduct between DMV fees that are deductible, real estate taxes, plus your California state and local income tax. And that number, and for most people, for a lot of people, I don't know most, but, is in excess of $10,000. So that excess amount was never, you couldn't get a deduction. Mm-hmm. And a lot of the states, California, New York, Connecticut, started screaming about this. And so the current administration changed the rules slightly. So the maximum deduction right now is $40,000. However, if your adjusted gross income is over $500,000, you lose 30 cents for every dollar your AGI is over 500. So for all intents and purposes, at $600,000 of AGI, your deduction ends up back down to the floor of $10,000. So it's better if you're in a high income year, or it's a year you sold a house. There might be some timing issues where you push the state and local tax into the next year or something, but it's better than nothing, but it's still pretty painful for a lot of people. I've got a lot of clients that have gone, I don't like this. So, yeah. But I think it's just a matter of knowing what's coming. And if you got an estimated tax payment and you're under 500,000 of the adjusted gross income, it's MAGI, which is modified adjusted gross income. And it turns out the modifications are with regard to certain foreign earned income, which not a whole lot of people have to worry about. Yeah. But if let's say your state and local tax and real estate, you come in at 25,000 and you've got an estimate that's due on January 15th of $10,000 for California, why not pay it in December and get the deduction? That's moving. You're going to have to pay it. So if you pay it 15 days early, you get a deduction and take it into reduced taxable income this year. So those are the kinds of games you can kind of play towards the end. And surprisingly, this is one that I've had a lot of clients that were on December 31 playing the game, or we used to play the game of, yeah, let's write a check. Let's write a check and get it in the mail and do it on the 31st, and you get the deduction, and it's going to clear the bank on the 2nd or 3rd of January. So you're only out the earnings for 13 days. So it's not too bad.
Yeah. Okay. Great. Thanks for explaining that. I know that was a big change this year for taxes. Let's go ahead and walk through charitable giving. So, important to note here that if you're charitably inclined, there are a number of ways where you can start planning for calendar year 2026. Now, a few things to be aware of: that donations must be completed during the calendar year, and they can include any of the following. So, of course, we can donate cash. Non-cash would be household goods or appreciated stock. Now, I'm going to take a pause there at appreciated stock because we have a number of clients who choose to donate appreciated stock. It is important, if this is your choice to do so, that you don't wait till the last minute to do it, because it does take time, for example, for Raymond James to be able to create the paperwork to donate the stock to the charity. And then in addition to that, the charity needs to receive the stock. Upon receipt of the stock, the charity will send an acknowledgement form to the client stating, thank you for donating 10 shares of Visa stock. We appreciate it. And then it is the client's job to go ahead and note that that was a charitable contribution on their tax return. The other thing that we can do is we can donate property that's other than marketable securities. So anything over 5,000 will need an appraisal in order to be able to show that it was over 5,000 and get the deduction for it. And then last but not least is going to be a donor advised fund. So a donor advised fund is a charitable giving account that allows you to make a tax deductible contribution now, and then you can grant to charities over time utilizing that account. So let's go ahead and address, Jay, if you don't mind, your view on these different charitable options, and then anything you think would be helpful for clients when they're looking at doing this for calendar year 2026 for tax purposes.
So one thing to remember is a charitable deduction reduces taxable income, which then reduces the tax. $1 of charitable deduction, if your tax rate is 30%, is going to reduce the tax by 30%, 30 cents. It's not a dollar for dollar reduction in the tax. It's not a credit. It's a deduction, first off. The second thing is, I think of all of these, the power of giving appreciated stock is really amazing.
Yeah.
And the reason being is, let's say you are a founder and you got stock that is basis is $1 a share, and the fair market value on the date you give it is $100 a share.
Yeah.
If you give one share away, your charitable deduction is $100.
Mm-hmm.
If you sold that one share and paid tax on $99, a gain of $99, and let's say the tax was a third, so you now have 60, you've got $100 less the $33, which is $67, and you gave the charity $67, you still paid tax on it and reduces the amount of money that goes to the charity.
Correct.
So giving appreciated stock is an amazing way of filling out your requirement or whatever your emotional needs are for benefiting the charity. You don't need an appraisal for that stock. You basically, on the date that you give the stock, you take the average of the high and the low for that day. It's not the open and the close, it's the average of the high and the low of that, and that's how you value the stock on that day. The other one is really neat, is a donor advised fund. There's been clients who said, look, I had a windfall. I had a lot of money. I really want to make a charitable donation. I don't have time or the bandwidth to figure out who I want to give it to, but I want to commit to set aside $100,000. Doing it as a donor advised fund or a DAF is fantastic. You write the check, you get the money transferred into the fund, your deduction is golden, and then you can dole out the money over the next 2 days, 2 years, 20 years. It just starts, you can just dole it out. And of course, there's a little bit of, I think there's a little bit of a load on most of the funds and stuff, but you also can invest that money and have it earned. And I've had clients who set this up, and the family then, the kids, get the kids involved, say, we've got this fund, kids, go out and figure out what charity you think you need or would like to see benefited, and it's a great learning tool for them. The last two things is in 26 and forward, there's two changes in the tax law. For non-itemized deduction taxpayers, you get to deduct up to $1,000 of donations on single filers and $2,000 for married filing joint. Don't even have to itemize. And the second thing is they put in a floor very similar to the medical deduction for charities, and that says that the contributions equal to the first 0.5% are basically, you've got to get to that threshold before you get to deduct any charitable contributions. So at $250,000 of AGI, your first $1,250 of contributions is not deductible, and everything in excess will be deductible.
Okay, very helpful. Thank you, Jay. And just to reiterate on the donor advised funds, if you were to utilize the example Jay walked through, the $100,000 contribution to the donor advised funds, and then you get to grant that to charities over time, you get that deduction in the year which you put it into the account. And as it comes out of the account and goes to the charities, that is not a deduction for you a second time.
Right. It'd be nice if it was a double dip.
Right? Yeah, that'd be really worth it. We'd all want one. Let's go ahead and walk through, 2026 tax estimates. So right now, I mean, we've talked a lot about pre-tax dollars, required minimum distributions, charitable contributions, and we all pay enough in taxes. We want to make sure that our clients are paying in enough estimated payments to avoid any penalties. So Jay, can you walk us through how this works from a tax planning perspective from the mind of a CPA?
It's interesting because this is just a set of rules. As the government wants their pound of flesh early, and if you don't do it, then you may be subject to a penalty. And the penalty is relatively simple. If in 2026 your estimates and withholding is equal to 90% of the tax that you will have for 2026, there will not be a penalty. And again, it's evaluated on a quarterly basis. This is for federal. And you tend to use the 90% of current year tax when a prior year tax was really, really high because of the thresholds if you're using the prior year taxes as an avoidance. If your adjusted gross income in 2025 was under $150,000, and in 2026, you pay an amount of tax that is equal to 100% of the tax of the 2025, there would not be a penalty, regardless of how big your tax bill is in 2026. But the key is it's $150,000. Right. Again, this is federal. If it's over $150,000, you've got to pay an amount equal to 110% of the prior year tax. So, and that's absolute. So if in the current year, your AGI was 100 million, and the prior year, your taxable income or your AGI was $10,000, I mean, you, for all intents and purposes, probably didn't pay any estimates at all at that level, even though the tax bill is going to be astronomical on April 15th. Now, that worked for federal. For California, they added a little additional twist, and that is if your adjusted gross income goes over $1 million, the only way to avoid a penalty is to pay in 90% of the current year tax. You can't look at prior years. And that makes it really, really difficult. And a classic is, on April 15th, if you've got to calculate what your tax is through March 15th, from January to March, you got to figure out what the tax is to pay in for California to be 30% in the first quarter. That's hard to do. And so it is a real challenge to keep within these. So the other thing is if you realize that you are short paid, the minute you make a payment and make yourself bring it back up where it is, the penalty stops running. But it is kind of the worst part of all of having to pay in enough. And again, that kind of comes with tax planning as you go, it's been a good year. Am I going to be covered? because you can't wait till the very last estimate. If all you're paying is estimates and paying everything you owed, well, you're uncovered for 3/4. So it's something you've got to kind of be aware of and right now. So
Perfect. Thanks, Jay. I think the takeaway there is take a look at what's coming, review your fact pattern from previous years in order to protect yourself from having to pay any of those penalties that come along with it. And last but not least, let's walk through gifting and estate. So when we're doing planning with clients, we often get the question around gifting without having to worry about filing a gift tax return. So this year for 2026, the annual exclusion for gifts is $19,000 per person. It's important to note that medical and education tuition are not treated as a gift. So two examples of that are, let's assume that my mom was in the hospital and she received a bill from UCSF for $100,000. If I were to pay that bill, or if I were to pay that bill directly to UCSF, I do not have to file a gift tax return because it's going from my bank account directly to the hospital bill. However, if I were to give my mom the $100,000 to pay that hospital bill, I would have to file a gift tax return because it's going to her and then it's going to the medical institution. Similar with education planning. So for college tuition, if you wanted to pay college tuition for somebody, if you pay directly to the college, you do not have to file that gift tax return. However, if it goes to the individual and then to the college and it is above that $19,000, you would need to file a gift tax return. Now, 529 accounts are college savings accounts, and they have an opportunity to do what we call super funding the account. So you can do up to 5 years of that $19,000 gift into the 529 account. So that would be $95,000 per person that could go into the 529 account as a gift this year. Now, the important thing to note on this is that even though that 95,000 is above the 19,000, you still have to file that gift tax return. Jay, my question for you though is if I file that gift tax return because I am putting 95,000 into a 529 account for, let's say, my nephew, if I file that gift tax return, does that eat into, or do I use any of my estate tax exemption by filing that gift tax return?
you know, it's a really great question. This particular vehicle of super funding of 529, there was a carve out, and it was saying, I think Congress said, look, what's the difference between putting $19,000 a year in for 5 years or doing it all in 1 year? It's really about getting kids, helping kids have money for an education, which removes the burden, I think, from society. You must file a gift tax return, and it turns out, I think it's on page 2 of the Form 709. Up on the top is you are actually making an election to treat the current year as the current $19,000 in the year you superfund as a current gift, and the 4 succeeding years as a gift in each one of those years, and it's elective. It's a special provision. It only works if you put the money in a 529 plan. You can't put it in a kid's bank account. It doesn't work that way. It's got to go into a qualified 529 plan.
Okay. Thank you for explaining that. And then also, I know this doesn't have to do necessarily with gifting an estate, but you shared with me a number of years ago a wonderful story about attending a funeral for one of our clients who happened to do some really wonderful things for education. Can you, or 529 accounts, can you share that that story with everybody on with us today?
Yeah, Barbara was a wonderful human being and a client, and she was not a believer in just giving people money. But she said to anyone in the family, if you go to school and you keep your grades up, I will pay for an education, is what the basic tenet was. And her son-in-law, who was a very prominent attorney in Oakland, during the memorial service, which, by the way, was packed, at the new cathedral, the Catholic cathedral, the newer one. And he started calling up people and asked them to come up, tell them the name and what education they had. And I will tell you, the lowest education was bachelor. There was probably a third were advanced degrees between masters and PhDs. There were doctors and lawyers, and there must have been 15 to 20 people up there. And Barbara paid for all of their education, and that was the gift. And she says, that's probably the biggest and the greatest leverage gift I can give, and that's an education. And it was fantastic, and it just really kind of made me a believer in education. She was proud of them. They were happy to do it. The competition between everybody getting grades was all public knowledge of exactly what the deal was. And it didn't matter. She said, if it's a trade you're going into, that's okay too. It's because it's getting the education. But it just is really, really cool. And I think it's a fabulous story.
What a beautiful story. Thanks for sharing. I appreciate it. Well, thanks for joining us today, everybody who's online with us for our tax planning best practices webinar. We hope that you found the time valuable with us this afternoon. Remember, if you have specific questions, please reach out to your advisor, who will then consult with Jay for the correct answer. Thank you, Jay. We really appreciate you taking this time with us today to go through this webinar. I love working with you. And we are recording this webinar as soon as compliance approves it, which can take up to about 7 business days. It will be available on our Summit YouTube page. Thanks again, everybody. Have a wonderful afternoon.
See ya.